Let's add all the startup costs we've thought about. So we've got the cart, we've got the kitchen equipment, we've got the coffee machine, the coffee cart, we've got a quote for $15,000. The kitchen equipment, all the things we need, $2,000, and the coffee machine, $999. We got it on special. They're really just one-offs in year one. We figured out we're buying $18,000 of capital items in year one, and we should put together a simple depreciation schedule to help us figure out how much depreciation expense we've got each year. We know we've got the cart, and we're pulling over the cost from the assumptions page. The cost of that cart is $15,000. The kitchen equipment is $2,000, and the coffee machine is just under $1,000. Now, the way to think about depreciation, as we've discussed before, is kind of what's the actual useful life of that asset, and what's the value you're getting from that asset each year. So let's assume the cart will last us 10 years. Make that useful life $10. So what this formula is doing is it's taking the $15,000 and dividing by 10 years to get a depreciation expense item per annum. So that's $1,500 per annum. Kitchen equipment, let's assume that lasts 10 years as well. And the formula is in there for us as well, but it's the $2,000 divided by the 10 years. Let's assume the coffee machine's only going to last us 5 years. And so that's $200 a year over 5 years. Because we're only modeling for 3 years, all those figures are valid for over 3 years, so we can use that as annual line items. Now, effectively, what we've done down here in the model is just show the breakdown depreciation expense. So the cart, we're depreciating $1,500 a year, and those assumptions have just been pulled from this annual amount. Again, kitchen equipment, $200 a year, and the coffee machine is only pulling for year one for some reason, but we need to do it for years 2 and 3.
Okay, let's talk about investment and interest. We're going to put two things in our assumption spreadsheet. Our equity investment is $20,000, and we're going to put an average interest rate on our cash in the bank of 2.5%. Okay, this maths gets super confusing. Stick with me. We're going to put our starting cash in the bank here. $20,000. Then our net interest expense, so that's the amount of money we start with minus our capital expenditure. Then we'll put that in brackets and times it by the interest rate, which gives us $950. A whole bunch of maths for a small number, but once the numbers get big, interest rates really matter.
Nearly there. Last thing, tax. Now obviously your mileage will differ, but let's just pretend we got a 30% tax rate. The calculation in our cash flow tab will look like this. Our tax payable is just the net profit times the tax rate, which means that our net profit or loss is just our profit minus the tax we paid. And just like our other margins, we can express this as a percentage by dividing our net profit and loss after our tax against our total revenue. Let me go through the last set of kind of confusing calculations about like cash in the bank and movements for the period and stuff. The easiest way to do this is just copy all the formulas from our template and then put your own numbers in the assumptions. Now that we've figured out our net profit and loss after tax, we can add back in the depreciation and amortization. We can deduct the capital expenses, which tells us after we have made money, paid all of our taxes, and taken away the amount of money we spent to start the business, we have the free cash flow to equity. That's kind of like once all the maths is done, we have the final number of making a loss or a profit for the entire year. Now we get to see how that compares to the starting cash we had in the bank, which in this example was $20,000, which means that our movements for the period, which is just a fancy way of saying like the sum total of the cash moving around for the year, equals starting cash in the bank minus movements for the period, which in our case is a $9,000 loss against a $20,000 cash injection, equals an ending cash in the bank of $10,000. At this point, it's important to consider that different accountants will deal with this stuff in different ways. So if you showed this to one accountant, they might actually be like, this has been done wrong. You show it to another accountant, they'll be like, it's perfect, I love it. Money is weird, and accounting for it is weird, and it gets really complex from this point onwards. But the important thing is that this is all of the important steps laid out one after the other.